All right, let's get right into it. Today, we're doing a deep forensic dive into a scenario that can be a real minefield for tax pros, calculating the basis for property someone gets as a gift, but that same property ends up back in the giver's estate. To do this, we're going straight to the source, Treasury Regulation 1.1014-6, and we're going to pick it apart piece by piece.
So this is the fundamental question, right? It's a tricky one because you have these two forces pulling in opposite directions. On the one hand, the property gets that beautiful step up in basis because it's included in the estate. But on the other hand, the new owners already had the property, maybe for years, and they've been taking deductions like depreciation. You can't just pretend that didn't happen. So how do you reconcile those two things? That's the puzzle we're going to solve.
So here's our game plan. We're going to start with the core predicament and the general rule, using a simple example to get our bearings. Then, we'll start adding layers of complexity. What happens when you have multiple owners? What about when only part of the property gets included in the estate? And finally, we'll loop back and see how all those pre-death deductions get factored into the final number. Okay, before we jump into any calculations, we need to make sure we're all on the same page with two absolutely foundational terms. Everything else we're about to discuss is built on these two concepts, so let's get them crystal clear.
First up, basis. This is ground zero for tax purposes. It's your investment in the property, the starting block you use to figure out everything from depreciation to the final gain or loss when you sell. It's simple, but it is absolutely everything.
And our other key term is fair market value, or FMV. This is the magic number, really. It's the value of the property on the date of the decedent's death. This is what gives us that powerful step up in basis under Section 104. Think of it as our brand new, much higher starting point. But, as we're about to see, we don't always get to keep the whole thing.
All right, let's get into the heart of it. The general rule from Section 1.1014-6A. This is the provision that tells us exactly how to take that shiny new fair market value basis and adjust it for what's happened in the past. So here it is in a nutshell. You start with the FMV at the date of death, and then you have to subtract any depreciation that was allowed to the taxpayer before the decedent passed away. Now pay very close attention to that word, allowed. This is so important. The rule isn't concerned with what was allowable, what you could have deducted. It's about what you actually deducted and received a tax benefit for. That distinction makes all the difference, as our first example is about to show.
Let's put this rule into action with example 1 right from the regulation. Okay, so a taxpayer gets a gift. It's later included in the donor's estate. The FMV at death is a nice round $50,000. Now, the depreciation they could have taken, the allowable amount, was $750 a year. But for whatever reason, they only claimed and were therefore allowed $500 a year, for a total of $1,000. The big question is, which of these numbers do we use to reduce our basis?
And the answer is $49,000. That's our final adjusted basis. We take that $50,000 fair market value, and we only have to subtract the $1,000 in depreciation that was actually allowed. Let's just hammer this home because it's a critical takeaway for any practitioner. The basis reduction is tied only to the depreciation the taxpayer actually claimed and benefited from. We subtract the $1,000, not the bigger $1,500 that was theoretically available. So the code isn't going to penalize the taxpayer for deductions they never even took. Now, example 2 throws a new wrench in the works, joint ownership. We have a husband and wife who own property together. The entire value gets included in the husband's estate when he dies, so the wife gets that full step up to $40,000. Great. But they had taken $2,500 in total depreciation over the years. So how much of that gets subtracted from her new basis? Well, you can't find the answer in the tax code. You have to look at state law. And in this case, local law says she's entitled to 50% of the income, so she's also allocated 50% of the depreciation, which leaves our surviving spouse with a final basis of $38,750. You take the $40,000 FMV and subtract her half of the depreciation, which was $1,250. It's pretty fascinating, right? A federal tax number is being determined directly by a local property law statute. It's just a great reminder that none of these calculations happen in a federal-only bubble.
Okay, now we're moving into Section B of the reg, and this deals with situations where you have multiple owners holding different kinds of interests in the same property. Like one person has a life estate, the right to use the property while they're alive, and someone else has the remainder interest. They get it afterwards. The question then becomes, was the whole property included in the estate or just a part of it?
So really, there are two paths you can go down here. If the entire value of the property is included in the estate, the math is easy. The shared basis for everyone, what the regs call the uniform basis, gets a full step up to fair market value. Simple. But if only a portion of the property's value is included, like just that remainder interest, well, things get a lot more complicated. We can't step up the whole basis, so we need a very specific formula to figure out the partial adjustment.
And that brings us to what is probably the most technical part of this whole regulation. When only a piece of the property is included in the estate, we have to pull out a specific formula to calculate exactly how much the basis gets to increase. Let's walk through this together.
We can break the logic down into 4 clean steps. First, you need your starting point, the adjusted basis of the entire property right before death. Second, figure out the total appreciation. That's just FMV minus your basis. Third, and this is the key, you create a fraction. You put the value that was included in the estate on top and the total value of the property on the bottom. Multiply your appreciation by that fraction. Finally, you just add that result back to your original basis.
Now, this is the formula as it's written in the regulation. Don't let the algebra look intimidating. All it's really saying is that the basis gets to step up proportionally. The percentage of the appreciation you get to add to your basis is equal to the percentage of the property's total value that was included in the estate. It's all about fairness and proportion. Okay, let's plug in the numbers from the example in the reg. The pre-death basis is $10,000. FMV is $20,000, which means we have $10,000 of total appreciation. Now, the value of the interest included in the estate was $8,000. So our fraction is 8,000 over 20,000, which is 0.40, or 40%. We multiply our $10,000 of appreciation by that 40%, and we get a $4,000 basis increase. Add that to the original $10,000 basis, and our new uniform basis is $14,000. And just when you think you've got it all figured out, the regulation adds one final crucial wrinkle in Section C. We've just learned how to proportionally increase the basis, but what about all those deductions taken before death? Well, we can't just subtract the full amount from our partially stepped-up basis. That wouldn't make any sense. We have to apply that same proportional logic to the deductions too. This final example really brings everything together. Let's walk through it. First, we start with our pre-death basis of $100,000. Next, we add that proportional basis increase we calculated, which was $33,333. That gives us a temporary subtotal of $133,333. But we're not done. Now we have to subtract the proportional share of the prior deductions. The total deductions were $10,000. The inclusion fraction is the value included in the estate, $100,000, over the total property value, $150,000. So we multiply $10,000 by 2/3, and that means we have to subtract $6,667. And that, finally, brings us to our answer. We take that subtotal of $133,333, we subtract the proportional deductions of $6,667, and we land on a final uniform basis of $126,666. You can really see how every single step, the initial step up, the proportional increase, and then the proportional reduction, all have to work together to get to the right number. So, after that deep dive, what are the absolute must-dos? Think of this slide as your compliance checklist. You have to verify every dollar of allowed depreciation. You have to nail down the exact inclusion percentage. You have to remember to check local law for joint property. And you have to apply that proportional logic correctly for both the basis increase and the reduction for prior deductions. Miss any one of these steps, and the whole calculation goes off the rails. And all of this brings us to a final strategic question. We've spent all this time on the nitty-gritty math after a death has occurred. But how does knowing all this change the advice we give our clients on the front end? Knowing that a partial step-up is this complicated and that pre-death deductions can chip away at that benefit, how does that influence lifetime gifting strategies? It's something every planner needs to think about. Thanks for digging into the regs with me today.